Hello everyone, my name is Timmy. I'm really excited you have visited my channel. In my last video, I introduced you to certificate of deposit. If you have not seen the video, please see the link below. In this video, I'm going to talk about understanding brokered certificate of deposit, CDs, a comprehensive guide. I explained in my last video that certificate of deposit is a kind of savings account offered by banks. While credit union offer similar product called share certificate, some state charter credit unions also offer CDs. CDs are a low-risk deposit account that allow you to save your money at a fixed rate over a fixed period. Traditionally, you invest in CDs directly with the banks issuing them. Another way to buy CDs is through a brokerage firm. This is called a broker CD. A broker CD is the CD you buy from a brokerage firm rather than directly from a bank. They are issued by banks, but the brokerage firms buy them in large quantities and sells them in smaller units to investors. Therefore, broker CDs have higher interest rate compared to traditional CDs. Since broker CDs are issued by banks, they are covered by the Federal Deposit Insurance Corporation, FDIC. If the bank that issued the CD fails, your money is insured up to the $250,000 limit. The differences between the traditional CDs and broker CDs include: 1. Traditional CDs are bought directly from banks, while broker CDs are bought through a broker. 2. Traditional CDs must be held until their maturity. Otherwise, an early withdrawal penalty may be incurred. Meanwhile, broker CDs may be sold before maturity without a penalty. However, there can be an associated transaction commission. Broker CD typically have minimum investment and increment, both of which are usually 1,000. However, some brokerage firms offer fractional CDs, making it possible to invest as little as $100 in CDs. Meanwhile, this could come with some restrictions. For instance, if you need to sell your CDs before maturity, you could be required to sell the entire fractional CDs that you have. Broker CD can be new issue or secondary issues. New issues are bought directly when the bank issues them, while secondary CDs are the CDs that are traded in the market before maturation. If the interest rate has gone up since the initial purchase, a broker CD could lose its value in the secondary market, and you may have to sell it at loss, or there may not even be a buyer for it. Advantages of broker CDs. Number 1, flexibility. In terms of the duration and the issue, broker CDs are more flexible. Broker CDs can have more flexible terms than traditional CDs. For example, some broker CDs have uncommon terms like 13 months, 60 months, and other terms. Number 2, ability to diversify and expand FDIC coverage. Broker CDs make it possible to compare and buy CDs issued by multiple banks in the same place without having to go to each bank's website. You may also diversify by investing in CDs by multiple issuers through the same brokers. Having all your CDs in one place makes them easier to manage, and it allows for FDIC coverage beyond the limit of $25,000 per individual per bank. The disadvantages of broker CDs include: Number 1, broker CD may be callable. CDs can be called, meaning terminated by the issuing bank before the maturity. This happens when the interest rate goes down and the bank does not want to pay customers higher interest rate than the current interest rate in the market. When a CD is called, the issuing bank will pay the accrued interest till the call date, in addition to the principal. If you still want to invest your fund, you will have to reinvest with a lower interest rate. To avoid this scenario, you may want to invest only in call-protected CDs. Number 2, fees. While there are usually no fees associated with new issue CDs, some brokerage firms will charge you fees to buy CDs in the secondary market. Number 3, lack of compounding. Unlike traditional CDs that are typically compounded, meaning interest are added to the principal and can also earn interest, broker CDs earn simple interest. The interest is added to your account, but only the principal can earn interest. How to buy broker CD? The first step is to open a brokerage account. In selecting a brokerage firm, you want to do your due diligence by checking the reputations and the reviews of the brokerage firm that you are interested in. If you already use a brokerage firm in trading stocks or cryptos, or you use it to manage your retirement account, you may want to use the same one. As a result, you will have all your investments in one place and they will be easy to manage. Some reputable brokerage firms where you can explore broker CDs include Fidelity, Vanguard, Charles Schwab, and Robinhood. The next step is to decide whether you want to buy new issue or secondary CD. If you plan to buy secondary CD, you may also want to consider the fees and the commissions when selecting a brokerage firm. The next step is to determine the term of the CDs. Broker CDs generally offer a wide range of terms, and the interest rate for each term may be different. So determine the term and the interest rate that aligns with your investment goals. Next, research the bank that issued the CD. Make sure the bank is financially stable and it is backed by FDIC. Determine if CD ladder works for you. CD ladder involves buying multiple CDs with staggered maturity dates. As each CD matures, you may want to cash out or reinvest your money. If reinvesting, it may be beneficial to set a rollover option when investing in CDs. When a CD rolls over, you have a grace period to terminate the CD if you don't like the terms of the new CDs. In summary, broker CDs provide stability and a reliable way to grow your savings over time. They offer more flexible terms and they let you invest in CDs of multiple banks in the same brokerage account, ultimately expanding your FDIC coverage. In choosing a CD, it is important to research both the brokerage firms and the issuing bank. I hope you enjoyed these videos. Please don't forget to like, share, and comment on my video. See you next time.